Question number 22. Deepak started a new company called Soft Bharati Private Limited with Ektara Limited. So this must be a joint venture, right? Where investment of 55% is done by Ektara Limited and rest by Deepak. So that Soft Bharati Private Limited is a joint venture, seems to be a joint venture. Voting powers has to be given as per the proportionate share. Yeah, no, it's the control only. That means Soft Bharati is the subsidiary of Ektara. The new company formed was the subsidiary of Ektara with the two directors and Deepak eventually becoming the one of the directors of the company. A consultant was hired and he charged 30,000 for the incorporation of the company and to do other registration. And you have to charge this as an incorporation expense. The company Soft Bharati was incorporated on 1st April 2019, a brand new company. Now the financials of Ektara are prepared as per Ind AS. Why? Ektara. Okay, financials of Ektara is its parent company is Ind AS. The moment for a parent Ind AS applicable, its subsidiary also becomes applicable. Now this is a brand new company, but Ind AS becomes applicable to it now. The accountant who hired at the time of company's incorporation prepared the draft financials of Soft Bharati. So they have told you revenue, expenses, employee. See this we understood, no? Increase, decrease in stock. These two things taken together is what? Purchase of stock, and these two things together, what it is? Purchase of stock and increase or decrease in stock in trade. This is called COX. Followed, no? And increase or decrease means opening stock minus closing stock. So your closing stock is more than the opening stock. Employee benefit expenses, depreciation, current tax and deferred tax is also there here in their P&L. Shareholders fund, okay, that person must have given in the old accounting standard format because he may not be aware that Ind AS is applicable here. Non-current liabilities, long-term deferred tax liabilities, trade payable. You have got non-current assets, long-term loans and advances, current tax assets, trade receivables, other current assets. Okay, now they give you certain additional information. Deferred tax liability of 6,000 is created due to following temporary differences. So during the year there was one deferred tax liability, no? Have they hit your P&L account? Yes, deferred tax expense has been hit. That means there must be one liability which we have seen already, liability. Now it is coming because of the difference in depreciation as per income tax and accounting profits. There is only one property, plant and equipment whose closing balance as per books is 1 lakh and as per income tax is 80,000. So if deferred tax is 6,000, so what must be the tax rate? 30% must be the tax rate. Yes, the pre-incorporation expenses are deducted on SLM basis over a period of 5 years. Book value minus this temporary difference, no? So temporary difference, yeah. One minute. Okay, here also capital advance is going to come. Now, however, the same has to be, same are pre-incorporation expenses are deductible. However, the same are immediately expensed off in the books of accounts. Now, as per income tax, you could have claimed for 5 years. Pre-incorporation expenses. So this also may be a subject matter of deferred tax. You remember in Ind AS 12, we have done this pre-incorporation expenses where book value is 0, is already charged in the P&L account, but tax base is how much? How much? Come on. Huh? No, did he consider this accountant? No, because there was no preliminary expenses in the books of account, no. Preliminary expenses was already written off. How much preliminary expenses you incurred? 30,000, which they gave you at the beginning. Now that 30,000 is already sitting somewhere here in other expenses. Now, since it was not there in the balance sheet, this 6,000 was calculated only on PP. He didn't know. So deferred tax asset or liability for you? On this pre-incorporation expenses, deferred tax asset or liability. Okay, for this, tell me what is my tax base? What is tax base? 24,000 at the end of the year, obviously. 24, because 30 is what you incurred. They are into 1 by 5 is what they have provided expenses. So book value as per income tax is 24. No. So on this, deferred tax asset or liability? This is an asset or liability, first of all. This is an asset, it is a fictitious asset. When the tax base is or tax book value is less than tax base, you have got deferred tax asset. Simple. What is the logic? For an asset, book value greater than tax base is equal to DTL. See here now. Why you recognize DTL? But for an asset which book value is 0, tax base is 24,000, DTA should come now. Clear? Simple. What is our Mool Mantra in India's 12? For an asset, book value is greater than tax base is equal to DTL. You forgot the logic. What is the logic behind it? I told no, you have got one house, you didn't declare there. One day they will come to know, asset house value is 100, but income tax record 0. They will say pay tax immediately on this unaccounted source. So we have got a DTL. Here we have got DTL, 1 lakh minus 80 into 30%. So here 0 minus 24, I got a DTA. Current tax is at 30% on profit before tax of 3,55,000 without doing any adjustment related to the income tax. The correct current tax after doing necessary adjustments and allowances related to income tax comes to 1,25,000. Okay, what is this 355? Have they made any provision? Current tax 1,06,500 they have said. Okay, so 1,06,000 current tax is calculated on profit before tax of 3,55,000 at 30%, whatever you see that 1,06,000. Correct, no? So 3,55,000 into 0.3, 1,06,000. But actually it should have been this. Anyhow, we will pass one rectification entry. There is an increase in the tax expense. After reporting period, the directors have recommended a dividend of 15,000, which has been deducted from the reserves and surplus. And they have grouped this 15,000 under current liabilities. Remove it. If you have declared the dividend, how can you make a provision for that? Now there are government statutory dues 15,000 which are grouped under other current liabilities. These are all non-financial. You have to have that breakup. Capital advances of 50,000 grouped under other non-current assets. This is correct. Other current assets of 51,000 comprise of interest receivable from the trade receivable, financial assets. And this is first one is the only disclosure is required and reversal is going to happen. Now the current investment of 30,000 is in the shares of a company which was done with the purpose of trading. And they have carried out the investment at a fair value of 50,000 as on 31st March. Investment is 30,000 which is sitting in the financial statement. But can you follow at 30,000? No. It should be FETPL. Can you have an FEOC option? No. Why? Held for trading. Actual gain on employee benefits remeasurement 1,000 has been omitted only. Oh my. So what accounting entry you should pass? Actual remeasurement was there. Okay, and it was a gain. You forgot it. Where it will go? Actual remeasurements. You remember which standard? 19. Is it an OCI item? No. But it is a non-recyclable. Huh? Okay, and on that deferred impact, tax impact is going to come. The financial statements have not been approved. You are required to ascertain that whether the financial statements are currently presented as per applicable financial reporting framework. See the beauty of this question. They have not even told you on the Ind AS applicability there. They said, is it applicable as per applicable framework? Now, which is that framework? Ind AS. How Ind AS becomes applicable? That's what first you need to tell. 1 mark. If not, prepare the revised financial statement after analyzing the above information. Followed, no? Yes, we'll quickly do this. First, applicability. Solution. Ind AS is applicable as it is being applicable to its parent entity. Ind AS is applicable as it is being applicable to its parent entity. Followed, no? So we have to prepare the financial statement in the given case as what is applicable to its parent, that is under Ind AS. So first you would say Ind AS becomes applicable. Next, second, we will do the working deferred taxes. Working note number 1, because what they did was wrong. Calculation of deferred tax. Okay, so we will have PP, item number 1, PP. Already how much is there? In bracket you can write 1 lakh minus 80,000. See, heading and all not required, no? Into 30% is equal to 6,000. We have got DTL. Are you clear? This is already there. Now we will see just how much additional required or how much total will be there in the balance sheet. Is there any item subject to pre-incorporation cost? How much is the book value? 0 minus 24,000. 1 lakh is 1/5 is already charged to P&L, no? As per income tax, into 30% is equal to 7,200 DTA. This is an asset for you. Is there any more items? Current investments. Third, current investment. Say 50,000 is the new book value, but income tax says only 30,000. FETPL and all we don't know. On this 30% gives me 6,000 additional DTL. It gives me additional DTL. So how much total? So 4,800 DTL. Now, on 1,000 where the DTL is going to come? It will come in OCI, no? It will affect. See what Ind AS 12 says. The presentation of the DTL should happen depending upon the original item on which it is done. So original item OCI will show in OCI. So DTL also will come there. When you present the revised P&L, then you can do that in the bracket calculation only. Followed, no? We can do it. It's a small calculation there. Okay, now write notes. Notes to accounts. 1. Current investment. PP and all, there is no change. Rupees 20,000 on fair valuation recognized in P&L because it is an FVTPL. It's an FVTPL item, no? So you will recognize in the P&L account. That means 1 lakh will be increasing the investment, second will be the P&L. Second, you have got non-financial assets bar liability. Capital advance. What it is? Non-financial. Then do you have any other item? Non-financial, financial, non-financial. Government dues, 15,000. Okay, what is your government dues? These are non-financial. Okay, do we have any other classifications there? Okay, dividend is going to get reversed. Government dues we have classified as a non-financial liability. Capital advances are non-financial. Other assets are financial. Okay, we'll write only first non-financial we are speaking. So there are only two items which are to be classified as a non-financial, under which are sitting in other non-current or whatever. Non-financial assets, these two. Next, dividend. What about the dividend? Reverse. Reverse and disclose. Enough, no? I simply say you have to reverse that dividend and you disclose the dividend. You cannot pass any accounting entry for declaration of the dividend. Then you have got other current financial liabilities. Okay, what are the other current financial liabilities you have got? Current financial liabilities, but falling part of other. See, current financial liabilities means investments is going to come, trade receivable is going to come, that cash and cash equivalent is going to come. Other than that, have they told you anything in the existing balance sheet? Forget it. Have they told anything in the existing balance sheet which is called current liabilities or something? Huh? Okay, so let me go to the P&L balance sheet. See, first of all, if I come here, shareholder reserve surplus, long-term provisions, no. Deferred tax, we are talking current trade payables, no. We will classify under financial liability. Other current liabilities. Okay, so other current liabilities. So first of all, what is the balance? 45,000. Is there any adjustment? Yes, no, because there is a reduction of dividend because dividend was sitting here. So we are going to give one statement, same like previous question. Dividend wrongly credited 15,000. Then one government due was there. Government statutory dues are grouped under other current liabilities. Can you see any statutory dues of the government? No, provisions will come separately, okay. Okay, so these are all not other financial, no. So we are removing that, less government dues. So from this, see, first of all, balance of current liability is how much? 45,000. Out of this dividend you have reversed. It will increase now. Government dues are non-financial, 15,000. So when you do, you get one amount called 15,000. Can you tell me what it is? Other financial liability. See, we have got trade receivable, we have got investments, trade receivable, cash and cash equivalent, then other financial liability. Now other financial liability, they didn't tell me in the existing balance sheet, they said other current liabilities. But in other current liabilities, if I remove the non-financial liabilities, understand slowly, from other current liabilities, if I remove non-financial liabilities, then I should be getting other financial liabilities. Understood? Yeah, this is the catch in this problem. Otherwise, every problem there should be one catch, no. Okay, next we will prepare P&L account. I think it's a small question. We start with the statement of P&L. as per schedule 3. First is the revenue from operations. How much? 10 lakhs. Then we have got other income. We have got only two heading in schedule 3. Revenue from operations and other income. Can you tell how much is my other income? 1 lakh 20. How did you get? 1 lakh was its existing balance plus 20,000 fair value gain. 1 lakh 20. Fair value gain was there, no, on that 50,000 on which we calculated deferred tax. So 11 lakh 20,000 becomes your income. Then expense. Which is the expense you will write first as per schedule 3? Purchase. How much is your purchase? Is there any adjustment? No. Change in stock? No adjustment. Employee benefit cost? What? What accounting entry you will pass for that? Remeasurement entry. Will you debit to employee cost of the P&L? It will go to OCA, no? The accounting entry will be deferred tax, PVDBO, present value of debt employee obligations to actuarial gain. So it will not hit my P&L account. So I have got employee benefit cost, I have got depreciation as it is, and I have got your other expenses also as it is. Now tell me if you have any items which is going to affect that. Yes. Now see, you are tampering with the P&L account. What did you tamper here entirely? Only 120,000 you added. Where is the second leg? Investment, no, in the balance sheet. See, ultimately your balance sheet should tally. Otherwise you have, see, it's a very simple, no. The catch comes in only that current, non-current only. You please focus on that. Here you have adjusted fair value gain. The second leg will come in the investment. That's it. None of the expense you touched. Tell me which item is there in other expense? Nothing, no. You just check. See, you can do one thing, classification. You see, certain items are subject to classification. How many mistakes are there? Mistakes are not there only here. Almost very negligible. So I'll move further and I'll say profit before tax. How much? 3,75,000 minus tax. What is your current tax? One lakh? 1 lakh? 25,700. They only gave you, no. They said 1,06,000 was coming by multiplying 30% on the profit before tax. But there were some mistakes, there were some adjustments. So actual tax liability was 1,25,700. When they only said, should we not pass one additional entry here? Where's the second leg of this? Provisions, tax provisions. These are all the only things we are touching now. Is there any change in the deferred tax? How much? Previously 6,000 was there. How much will come? 4,800. And the second leg will go into my deferred tax liability. Because my actual deferred tax liability was only 4,800. Accountant left certain items and he passed one accounting entry for 6,000. So his expense entry was the deferred tax expense to deferred tax liability. Now I will revise it and bring it to 4,800 by reducing liability, reducing expense. So my correct profit is, okay, 1,30,500 is tax expense. So profit is 2,44,500. This is profit for the year. So we understand that there are three adjustments. One is of the deferred tax, one is of the current tax, and there is the other income. Should I not prepare a OCI? So right below this only, other comprehensive income. What is the first item? Heading? remeasurement gain, recyclable or not recyclable? Employee benefit, this remeasurement on the actuarial gain, recyclable, not recyclable. It is not recyclable. See, this is what standard says. No, like revaluation surplus, not recyclable. FCTR, recyclable. Debt FVOCI, which one? We are debiting now. How we are debiting? Current service cost, past service cost, like that we are debiting. Some differences come, standard says you don't take to hit because that numbers are very hypothetical numbers. So one day some big number, big difference may come. Okay, so better you don't take it. The day you settle this liability, you take it from there to retained earnings. So it is items are not recycled. So they have given, the standard has given the list there. See, our effort is just to understand the logic why they have told not recyclable, but they are not recyclable. 1000 is a gain. Is there anything else? Tax cost on above, how much? 1000 into 30%. This is the deferred tax, plus or minus. Do you have got a deferred tax asset or deferred tax liability? What is this? Now, which is item I should look in the balance sheet? PVDBO. Huh? For PVDBO is a liability. What is the book value? Minus 1000 is the fair value gain. Tax base 0. For a liability, when tax base is more than the book value, what do you have? For a asset, book value is greater than tax base, you have got deferred tax liability. For liability, book value is greater than this, deferred tax asset. So here, if it is a liability, book value is greater than tax base, you have got deferred tax asset, ulta. For asset, book value is greater than tax base, liability, no? For liability, book value is greater than tax base, asset. But this liability, book value is less than that, that means you have got deferred tax liability. Huh? Very good, no? That means you mind started to calculate. So 300. For you clear, no? It's a deferred tax liability. Because you have recognized a gain means your liability balances have come down, but income tax doesn't recognize it only. So closing balances, you got this deferred tax liability. So net OCI will be 700. Clear, no students? Yes. So next thing, we have done the P&L account. We will do the closing balance of equity, which is not there in study material. I don't know what they have done. Can you tell? I will start with the balance of reserve and surplus. How much in the closing balance of reserves and surplus in the balance sheet? 227,500. So there are certain plus and minus adjustment to this retained earnings, no? Reserves. Okay, go to the adjustments and see one by one. First adjustment is what? Sorry? Profit for the year would have got added, no? This would have got added back. We will look into only the adjustments. After adding, you got a closing balance sheet, no? Now, if there are certain changes, my closing balance is going to change now. Dividend. So first I will write what? Add or minus? Add. Why? Because my accounting entry was dividend expense account debited to dividend liability. Dividend liability I deducted from the provision, so I removed it. Dividend expense debit or debit or retained earnings. So add back dividend provision. Are you clear? No, there are two legs. No, simply you cannot remove from the balance sheet. This side you should remove, add it to the liability. 15,000. Now tell me, is there any other item? Huh? Profit, see again I'm telling, if you want to do that way, then you should ascertain the opening balance of the retained earnings, because if, see, there are two things. Did this profit consider all the adjustments? Correct, no? Now, if you have got a closing balance, from this, remove the wrong profit sitting there. How much wrong profit is sitting? Previous balance sheet, P&L account, how much they said? Remove it. Add this profit. How much you should get? Followed, no? Otherwise, okay, it is not there. How much is the previous closing balance? 1 minute. Let me check. So your closing balance of reserves is how much? 2,27,500, correct? So I will write 2,27,500 minus your wrong P&L. How much is your wrong P&L? 242,500 plus correct P&L. How much? 245,200. So how much it comes to? 227,500 plus 242,500 minus 245, 224,800. No, 1 minute. Yeah, we can do this way also. How much is wrong P&L? 227,500 plus 15,000. 15,000 is also there now. Dividend was not part of the P&L previously, it was part of the retained earning. Minus wrong 242,500 plus 245,200. Numbers are so beautifully crafted that these two numbers will exactly match with this number. Effect is going to become 0. Then you add back, you get the 245,200. This becomes your closing balance of P&L. Followed, no? Have you understood this? Everyone clear? Nice numbers, right? Alternatively, what I have done, forget about this, you could have done this way also. See, first of all, you have taken the closing balance. You have taken the closing balance. In this closing balance, there was one wrong adjustment for dividend which has not hit your P&L account. So I will take that 15. And if you see from here to here, these were all the 4 adjustments. Like one is OCI deferred tax, newer deferred tax, increase in tax expense, fair value gain. If you adjust all this, then you get 245,200. It is not there in the study material. Anyhow, you can do any method. Followed? No, I don't know. I think they have put straight away directly or whatever it is. Have you understood the difference? How did we get it? Yes. So we have understood. Straight away we'll move to the balance sheet. See, very small question. That current, non-current is the only irritating thing. We have got assets, non-current assets, PP. No adjustment only. Is there any adjustments? Deferred tax mistakes and all of that. Even though deferred tax is not going to affect my PP only. Below PP, what I will write? RO asset is there. Investment property, CWAP, bearer plan, goodwill, intangible assets, financial assets. Yeah, we have got financial assets. Under financial assets, do I have investments? No, I have got other financial assets. How much? That is note number 1. 40,000. So this question I can say predominantly on the deferred tax related thing and your current financial non-financial. Done. And then I have got a capital advance which I will write under financial assets other non-current assets, which is capital advance. So I have got 50,000. Yes, my non-current assets are done. Tell me students, is there anything else? Understood, no? Okay, next what should I write? Current assets. Okay, I'll write the heading called current assets. Under that, first is the inventory. No change. What is my second one? Financial assets. Under financial assets, investments. Do you have any investment? Current investments is how much? 50. 30 plus 20. Yeah, with this, that second leg of that one fair value adjustment I am completing, 50,000. Till now, we have not touched the P&L account adjustments in the balance sheet. We have checked that in other equity. Okay, now next, what is after investment? Trade receivable. Is there any adjustment? No. After that, CCE. Any adjustments? No. After that, other financial assets. Okay, like this 3-4 times you do, no? I'll share some more questions. This becomes very clear to you, that writing pattern. Okay, financial, other non-current, current non-current, like that, no? So how much is my other financial assets? Interest from debtors. Did we not write one note there? The money to be received from the debtors is your other financial assets, no? 51,000. We separated it, no? So you have got the total of the assets 5,41,000. See, out of everything, whatever adjustment to the profit we have done, we have adjusted, or maybe I have done this way, that individual item, so as to have, okay, maybe you can do it at a total profit level also. Fair value adjustment only we have done, and dividend declared and all will come now on the credit side. Okay, now coming to the equity. How much is my equity share capital? 1 lakh. Is there a change? No. Other equity 245, 200, which you already done the working note. So our job is to give that second effect there. Now all the P&L effect is coming here now. Out of this, now only one leg we have adjusted called a fair value gain there. So you should remember now, the fair value gain was in other income. Deferred tax related will come in deferred tax. Current tax will come under current tax liability. So all P&L, there are 4 adjustments. 4 adjustments should get reflected in the balance sheet. So then we go to non-current liability. What is the first non-current liability I have got? Provisions. How much is my provisions as of now? 25,000. Sorry. Yeah. How much is my provisions today? 25. Is there any adjustment to this provision? Current tax will go under current provisions. No? We are talking about non-current. Yes. Question is clear? Yes, Aditya. Under provisions, the current balance is 25,000. Is there any adjustments we have done in the P&L account which is or OCI which is going to hit my provisions? Okay, in P&L how many adjustments you have done? One is the fair value gain. How much? 20. Have we added to the non-current investments? Yes, current investments we have done. Then tax provisions. Income tax increase, no. Where we are going to give the second effect? Under current provisions. Deferred tax expense got reduced. Where is the second effect? Deferred tax liability. OCI. How much is the effect in the OCI? 700 is net, Baba. 300 effect will go in the deferred tax. 1000 will go where? What accounting entry did you pass in OCI? Tell me. What accounting entry did you pass in OCI? There were two entries, no? When we are talking about the retained earning, we took net 700 because net effect was 700. But entries were two, right? Can you tell me what is the accounting entry you passed in OCI? PVDBO to actuarial gain. How much? 1000. Deferred tax liability, deferred tax expense OCI to deferred tax liability 300. This is the entry we passed. Now my question to you is where do you show this PVDBO debit? That is this long term provisions, no? PVDBO, is it not a provision like a decommissioning liability? But in follow, no, it's like a decommissioning liability, no? Minus 1000. They didn't tell you with a separate name called the present value of the defined benefit obligations. But what you did there was a provision. It's just like a decommissioning provision. So you deduct it here and say 24,000. So out of this, see, OCI we had got 1 plus 2. This we have done. This we have done. This is pending. This is pending. This is pending. So all tax effect second leg is pending. Taken together, net effect where we have given in retained earnings. All these 1, 2, 3, 4, 5 items net effect we have given in retained earnings. Current investments done. This is done. So 3 things are pending now, which will go into my deferred tax. Are you clear? You are following? Which one? When you will pay? End or at the time in 2040 when you retire? What is PVDBO? Before defined benefit is when? Now, next year, or when you retire? It is when you, otherwise it would have been a short term provision, no, Baba. Like your leave encashment is a short term. There are 4 types of, I will remind you, 4 types of expenses: short term, defined benefit, other long term, and termination benefits. So when you talk about the post employment benefits, there are 2 things called the defined contribution and defined benefit. This was a defined benefit, but it's a post employment benefit. So obviously it should be a non-current. Perfect. Okay. So now last, then what? Deferred tax liability. How much is my deferred tax liability as per existing balance sheet? 6,000. You completely minus that and bring it back to down to 4,800, and plus 300 you are going to add. So it is 5,100. Previously it was 6,000, but you said 6,000 is wrong number. It is 4,800. That means you must have reversed with 1,200 entry, no? Alternatively, you can show like this: whatever balance sheet value 6,000 minus 1,200 you reversal plus 300 in the OCI. With this, almost all the P&L adjustments you have done except current tax increase. I'll move to the current liability portion now. What do you have got in current liability? First one, trade payable. Is there any adjustment? Trade payable. That's what. Current liability, financial liability, trade payable. Current liability, financial liability, trade payable. Under trade payable, I have got one more line. Is there any loans? Loans and advances taken. How much? We don't know, no? Have they it's in one other problem we took that. Loans should be separately presented. Well, we have moved it to other, no, government dues. So we have got other financial liability 15,000 and the government dues, what we will call? Other current liabilities. Okay, see, even though you missed, no, don't worry. 1 or 2 marks risk. But please study. With the practice, it should be okay for you. Is there any item left? What one? Current short-term provisions. So what you have got in short-term provision? How much? 1,06,000. For this, increase the tax liability, no? So how much you increase the tax expense? Whatever it is, what you have shown in the P&L. Whatever is there in the balance sheet, plus you must have passed one additional entry, no? To show in the P&L. With this, see, all 5 adjustments of the P&L account, which will cumulatively go and sit in the retained earnings, has been respectively adjusted at other places with the proper current, non-current classifications, and your balance sheet is valid. Huh? Current tax liability is okay. How much is sitting as of now in your P&L account? 1,06,000. How much is right now? 6,500. In your revised P&L account, how much is there? 125,700. Did you pass any accounting entry? Yes. Tax expense account debit to tax liability plus the difference between 125,700 and this. When you add, you get only this one, no? Perfect. Yes. Next, we will prepare other equity. Again, equity share capital you leave. Other equity. What I have done, no? Now I remember. I written not in study material, no? They have given as a other equity. What I have shown there, like plus, that I have done working note, but it is not there in the study material. That I have done. Why I have done? For our understanding, so that where are the second leg has to come. Otherwise, yeah, we could have done that opening profit minus previous profit, wrong profit and all we could have done. But when I have given that breakup, my understanding is, look, I will just put a tick mark and check the second leg. Now, what you are supposed to give is as per schedule 3. Can you tell me, guide me students, how many columns I should have? First tell me how many columns I should write. Huh? That is row, no. Columns I am asking. Retained earnings. Which OCI? That remeasurement OCI. Okay, then total. So now I'll write retained earnings, OCI of the remeasurement, total. So what is my opening balance? I don't know. Total comprehensive income is how much? Because I don't have any opening balance. No, new company, right? Where's the opening balance here? How much is my total comprehensive income? $244,500. This is what you have taken from the reversed P&L, no? And your OCI is 700. So 245,200. So your total will be 244,500 plus 700, 245,200. Okay, so there was some statement of changes in equity also. There is no change in the equity. You can practice it later. So this working they have done there. Now suddenly if I take this, now can you tell me how the balance sheet is getting tallied? If I would have prepared this and say, okay, prepare this way, you would have wondered how my balance sheet is telling. You did straight away adjustments there. Tax is not this, this is the tax you took there. Deferred tax is not this, you took there. Understood ICA style? ICA prepared this, took this total and added there. But to adjust my balance sheet to my get my balance sheet tallied, should I not have the breakup of how many adjustments are there now in a tallied balance sheet? There are 5 adjustments. That breakup I gave there. Perfect. Yes. Last note will be disclosure dividend. Right? Dividend. Disclosures forming part of the financial statement. Yes. With this, we are done with the analysis of the very nice chapter. I like it. Okay, so you will okay. So we'll just have a quick look at the balance sheet. Now we are almost all done with all the standards except theoretical. PP 16, ROU 116, capital work in progress 16, investment property, goodwill. Can I recognize internal generated goodwill? No. Then from where goodwill came? Goodwill will come from your 103, no. Business combination, internal generated goodwill are not permitted. So how I can recognize goodwill through 38? Correct? That means for schedule 3 this is applicable. This same format. See, in schedule 3 you have got division A, B, C. A is for accounting standard, B is for your Ind AS, C is for your consolidation or something, NBFC I think. Here you have got part A, B, C, 1, 2, 3. See, for consolidated financial statements also, for standalone financial statement also, you have got the same format. Something not applicable. Because if you are preparing SFS, this doesn't become applicable to you. If it becomes a CFS, this becomes applicable. Are you clear? Now, other intangible assets, 38. Intangible assets under development, 38, not yet available for use. And this we will test for impairment every year. Biological assets other than bearer plant, bearer plants, 16. It is part of note number 1 there. Financial assets, you can say 109 will say for simplicity's sake. Now this will include 2. One coming from 109 or cost. If you talk about cost, then it must be 27, provided it is equity. There can be certain investment in debt also. That is a different story. It's all from 109. Followed, no? Debt you will not record at cost. It's only for equity, for which if it's an associate or a joint venture or subsidiary investment. Trade receivable, everything, financial assets itself is 109. But we have got some other financial assets. See, if you see the face of the P&L, we have got investment, trade receivable, loans. That's why in one of the question we separated that 40,000 rupees loan and put it at the face in correction of the opening transition to India's problem. Because we said loan should be on the face. Then all other thing will be the other financial asset. Deferred tax is not a financial asset. So after this it will go to the deferred tax. And all other will be other non-current assets. You don't call it non-financial assets. Now, then everything will come there. We'll move on to the current inventories. 2. Again financial assets came. 109. Trade receivable, cash and cash equivalent, bank balance, loans. Again loans separate and other financial assets. Current tax assets. Like suppose TDS and all are there, current tax, TDS receivable, non-financial. But separate disclosure, you cannot put TDS under other current assets also, or you can have classified. Now other current assets, non-current assets held for sale, 105. On day 1 I was telling, no? On day 1 I was telling the numbers. Okay. So now good, so fast, okay. So now feeling comfortable, no? You know now where these numbers, what is the rule behind it, what is the logic, why this comes. I'll go to the equity share capital. Not 9. It's liability or equity, no? Other equity, not 9, balancing figure. Financial liabilities, we know that trade payable other financial liabilities. That's why we were all doing this other financial liability there. Provisions 37, deferred tax 12, other non-current. We don't say other non-financial. Financial borrowings again under current liabilities, same story. Provisions also 37, other current liabilities, current tax liabilities. That's why current tax liabilities we have shown last. We go to your favorite 115. Other income can come from different, like income, borrowing, dividend income and all those things. Cost of material consumed, 2, purchase 2, and okay, yeah, we can say 2, this is also 2. Employee benefit expense 19, finance cost, very much interested. Wait, from where? 20, 23, 109, 116, 16, decommissioning liability, then 37, provisions, whichever you discount you have to do, and more importantly 21. If we have taken a foreign currency loan, the interest differential of your local borrowing, followed, no? We have done that, part of the borrowing for finance cost, even though it's a forex loss. Depreciation and 38, amortization is meant for that. Impairment 6, other expense, leave, balancing leave. Finance cost. No? In 115 also we have discounted, right? If we received advance from the customer, we discount it. Non-contract liability and finance cost. Profit before exceptional items, profit before tax, tax expense 12, discontinued operations 105. EPS will later. Okay, profit from discontinued, tax expense on the discontinued. So you say single one line item here. For others, you show the breakup. You have done that, no? OCI not to be recycled, revaluation surplus 16, revaluation surplus. Remeasurement of defined benefit obligation, equity of OCI. Okay, share of OCA equity accounted investing 28. Income tax 12 on all above. That's what we have done now. On remeasurement, we calculated income tax in OCA. Exchange difference 21, debt equity OCI, cash flow hedge. See how many portions, places we have written 109. Share of equity 28. Now total comprehensive income you got. Now earnings per equity share for continuing operation 33. Discontinued operation provided control number is positive. Otherwise you will not show this discontinued operation because it becomes anti-dilutive. And for the continuing operation, whatever it is. Followed, no? Yes. With this, SOC opening balance we have done. Vertically also you can present, horizontally you can present, where you will say opening balance, add changes during the year, nothing. Other equity, you see opening balance, equity compound, we have added. General reserve, you just show like that. Other reserves, whatever, capital reserve or whatever, in consolidation chapter we have done. Retained earnings will have the profit for the year, total profits. And OCI will go under respective head. Like just now we created one head called here, actuarial gain, and that OCI thing we added there only. So total this we will show in the balance sheet. Okay, any changes in the accounting policy, dividend pay, distribution tax, transfer to reserve and all? Yes. Okay, so this offsetting and all we discussed this theory. And this is the compound instrument. We did know that 4 lakh rupees something was there. In other equity, we added one more column for compound instrument. Previous question. Which one? 1 minute. Clear now, students? Yes. Thank you. Done with this.